Welcome, ladies and gentlemen, from me, Guy Monson, to our regular 6-minute strategy summary. Relatively flat financial markets for 2023 to date belie the extraordinary turmoil below deck. The US regional banking crisis and funding problems at Credit Suisse have caused some of the most aggressive swings in short-dated bond markets in 20 years. And with central banks rushing to the rescue, it of course triggers memories of 2008. While dramatic though, these shocks are not anywhere near the magnitude of the great financial crisis, and are not untypical of what occurs whenever central banks lift rates sharply and quickly. We have in fact experienced 3 policy-linked shocks in the last 6 months. First, the gilt and pension crisis in the UK in September, then the crypto collapse of FTX in November, and now today's banking turmoil. We will look at where this now leaves markets for the rest of 2023, what the outlook for peak interest rates is, and whether the risks of recession in the global economy have materially risen in the slides ahead. So let's begin in the left-hand panel looking at the performance of financial markets 2023 to date. Surprisingly, the numbers are very stable. Yes, equities have come off their highs, but they're still up 1% for the year to date. That's the dark blue line. Gold obviously rallied strongly, up 5%. And after this rally in bonds, UK gilts are up 3% for the year to date. On the right-hand panel, looking at some other indicators, the dollar index has crept up marginally by 1%, but it's not showing a worrying flight to quality in the US dollar. And usefully, oil prices have come down again sharply, down 16%. That'll help economic growth later on this year. So what sort of liquidity conditions are we looking at that have triggered these problems? Well, the US is tightening on all fronts. As we've talked before, they're going from QE, quantitative easing, to quantitative tightening. So you can see in that top bar the Federal Reserve balance sheet beginning to roll over. And that's as a result of monthly bond sales of somewhere around $75 billion a month under current conditions. That's of course got to be combined with a sharp interest rate rise, 8 moves in the last year, up to 4.75%. In addition, the commercial banks are tightening. I've shown here the Senior Loan Officer Survey. This is when you call up senior bank officials and say, are you tightening conditions for your loans or loosening? And you can see both business and household loans in red and blue are beginning to tighten quite aggressively. So this is quite a harsh environment. And it's triggered, of course, a sharp sell-off in US and global bonds, with on the left-hand panel here, the blue line, the US 10-year bond yield rising from 1.5 to almost 4.5 in just 11 months. Put these all together and it's quite enough to trigger some breaks, if you like, in the financial system. The first of these was the UK pension funds and the LDI funding crisis after the ludicrous trust quarantine budget in September. The second was the collapse of FTX and the problems in the crypto market in November, and now of course this regional bank crisis. We at Saracen have come through the first 2 well. I'm afraid, like other banks, we have got some modest exposure in some mandates to some of the mid-tier banks that have caused problems in the US. On the right-hand side, I've also put the US yield curve inversion. That's among the steepest in 40 years. That's when the short rates are higher than long rates. And that puts additional stress on the system. And you have to go back to the Volcker years, back in the late 70s and early 80s, to see anything like what we've got today. So how bad against this backdrop is Credit Suisse? Well, I'm going to try and do something no one's ever done before, which is explain the Credit Suisse balance sheet in 30 seconds. This is from the bank. It shows total loss absorbing capacity of 99 billion francs. 49 billion are available to the bank if it goes into liquidation. It's not trading anymore. And the remainder are available down to regulatory limits when the bank is a going concern. Now look at those as a percentage of total capital, and you can see that at 39.5%, they're way above the 25.1%, which is the Swiss capital requirements. So actually the bank is very well capitalised. The problem was this is a struggling franchise, it was vulnerable to tearing sentiment and endless negative headlines, and of course the US crisis triggered the problems further. So I think the circuit breaker that the Swiss National Bank has put in with the 50 billion credit line will stop this being systemic within the European system. So what does all this mean for interest rates? Well, ironically, the good news is that the peak in interest rates is probably lower than we expected because of these financial problems. And remember, for most central banks, financial stability trumps inflation control. The Federal Reserve terminal rate is now expected to be somewhere around 4.80. That's a little different from today's rate of 4.75. So we might get one more rate rise, but we could also get a rate cut. My hunch is they'll pause next week to understand underlying banking conditions. The Bank of England also meets next week at 4.21. That would argue for one more quarter base point rise. I think that might be a little bit too dovish, but certainly we're beginning to pull in those numbers. And as a result of the budget yesterday, the inflation numbers should actually be quite good here in the UK as energy prices fall. So let's wrap this up for the global economy. And I've shown here quarterly GDP numbers, green for increases, red for decreases, for G20 countries. In that left-hand panel, the latest number, Q4 2022. And what you'll see is first a lot more green than red. Secondly, not too many reds coming in succession, which indicates recession. And indeed some strength, particularly out of the US last quarter, and of course out of China as the economy roars out from the underlying COVID lockdown. Put together, I think we'll still probably avoid a global recession next year, so we don't need to be tilting portfolios too aggressively to match this. So let's wrap up. Keep your bond yields neutral, keep your quality up, but if you see real opportunities in quality non-cyclical names outside of the banking sector, add to exposure. In global equities, we're modestly underweight, focusing on particularly dividend growth and beginning to look for opportunities in a resurgent Asia. Finally, in our alternatives book, we continue to hold a position in gold and other commodities as a hedge against the long-term inflation issues which still haven't gone away.